Kitco Mining's special coverage of Mines and Money in Miami, Florida is brought to you by Gold Shore.
Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 Mines and Money Conference in Miami in Florida. We are talking about investing in the precious metal space and the copper space. And I'm joined by David Finch, CEO of Ixios Asset Management. David, welcome to Kitco.
Thank you. Good to be here.
Now, obviously, I messed up the pronunciation of your company's name, so clarify a few things for us. What is Ixios and what does it do?
So we're a boutique fund management firm based in Paris, France. We used to be part of BNP Paribas Group. We did a management buyout about 4 years ago now. We're very focused on mining, so most of our money is in three funds. Gold, precious metals mining fund, a fund called Energy Metals, which invests in most of the metals needed for the energy transition. And we have a smaller fund which we launched recently, which is a copper mining fund, so investing in producers of copper.
Okay, well, let's start with the precious metals. Gold is setting a frenetic pace. I believe it's hit more than 40 all-time highs over the past year, currently over sort of $2,900 per ounce. What are some of the things driving gold?
Well, I guess, the longer term themes which have been in place for a while are central bank buying. I don't think that's a very original interpretation, but it is there, and it's, I think, relatively price insensitive. I think it's been driven by a perception by central banks that holding the debt of other countries in your reserves is a less and less tenable position, particularly after the US sanctioned the Russian reserves held in US and European debt. And I think that's a long and structural process. It's going to take a decade, I think, for most central banks to make that kind of transition. And it's interesting that that's not, it was partly politically driven at the beginning, but when you look at the central banks that are buying, they're not necessarily central banks of countries which are opposed to the US. So, you've had countries like Singapore, Saudi Arabia, Poland be big buyers of gold. So I think there is a structural kind of backdrop going on there. I think this more recent rise has been driven by this squeeze in the physical gold market. Holders of futures standing for delivery, and some people have responded to that by bringing gold into the US to deliver against the COMEX contracts, and some people have responded to it by covering their shorts. So I think that's been a big feature driving this rise that we've had since the beginning of this year. I guess in a way that is more short-term in nature. As we have seen in the past with the squeezes that we had in the nickel market a couple of years ago, these things tend to have a very strong impact in the short term, and then they tend to die down a bit. We shall see with gold. As everybody knows, the amount of futures contracts outstanding completely dwarfs the amount of physical gold available to deliver against them. So that's been the case for many years now. We'll see if enough people stand for delivery to actually cause some kind of failure in the futures market.
So as you put together, or as you maintain your strategies, your investment strategies, are you sort of bullish for the gold going forward?
I am bullish for gold going forward. It's had a hell of a tear over the past 12 months, and it's had very few corrections along the way. It had one after the US elections, but that was fairly short-lived. I guess there's a bit of a sense of vertigo here. That maybe
uncharted territory. Yeah.
Maybe we need a bit of a correction, but certainly doesn't seem to be much sign of it yet.
Despite the high gold prices, I think it would be fair to say that in general, investors still seem to be hanging back from the gold sector and gold companies in particular. As an investor, what is your view of gold companies in general? What do you like? What do you not like?
Yeah, look, I kind of don't hide this from anybody. I think gold mining industry is not a high quality industry, right? It's hugely capital intensive. Gold mines have short lives, so a lot of the free cash flow that companies generate has to be applied to reserve replacement, so investing to replace reserves. And so historically, the free cash flow yields of the sector have been poor, even in bull markets. I think we're kind of in a situation now where the gold price has moved up so much so quickly that a huge free cash flow margins opened up, because costs, although they're going up, are not going up as quickly as the gold price. So, and I think that this, the next 6 months or next year will be a big test for the gold mining industry of what they do with this free cash flow. Because at the top of the last bull market in 2011, they didn't cover themselves with glory. There was a lot of kind of pro-cyclical investment went along at the top of the cycle. And I think that we'll see, who actually returns cash to shareholders and who reinvests it all in an attempt to grow production.
We're going to pick through some of those themes a little bit later in our conversation.
Yeah.
The gold sector, certainly the big guys, have made a concerted effort in recent years to try and become more appealing to the investor community, and perhaps addressing what you said as not being a high quality industry. What do I mean by that? So Barrick, Newmont giving 10-year production guidance, trying to exert or show more capital discipline so that they are mature, robust businesses that can be trusted that investors can trust. How well do you think they're doing? What should they be doing?
Well, look, I think that Newmont in particular has probably come to an awareness of that structural problem, and so you've seen that they've had an asset disposal program where they've sold a number of marginal assets. They've actually backed away from giving longer term guidance now. They are, I guess, more shareholder friendly in terms of their capital return policy. Not as much as Anglo Gold Ashanti, who've put in place a pretty robust capital return to shareholders policy. I think that they're probably, among the large caps, they're probably the leader in that. As for Barrick, they don't have a lot of free cash flow to distribute at the moment. So, they've got other problems to worry about. And they also, I guess, have a big capital investment program now that it looks as if they're going to go ahead and build Reko Diq in Pakistan. Okay,
let's talk about free cash flow you mentioned just now. We're in the midst of the 2024 financial year reporting season. Let's say about half companies have reported, including some of the big guys, more still yet to report. So far, according to the figures I've compiled, gold companies last year returned more than $6 billion to shareholders, about 2/3 of that via dividends, about 1/3 of that in share buybacks. That figure, that $6 billion, is very roughly twice what they returned in 2023. So from that point of view, it seems that the gold companies are going in the right direction in terms of returning capital to shareholders to, appeal more to shareholders.
If you look at the market cap of the GDX today, of all the companies in the GDX, which is most of the industry, right, that's about $450 billion. So 6 on 450 is not a great free cash flow yield.
So should they be more aggressive?
I think so. Now, obviously, companies have to sustain their existing mines and they have to replace reserves. And that eats up some of the cash flow that's generated by a gold mining operation. But I think the industry also, in my view, spends too much of that capital on trying to grow production. And as an investor in the sector, that's not what I want. I would much rather have a company that has stable production, which invests just enough to maintain production at its existing level and returns the free cash flow to shareholders.
Okay. You mentioned earlier that costs continue to increase, although the gold price is outpacing that. That means that a number of companies now enjoy all-in sustaining cost margins of well over $1,000 per ounce or more. Industry leaders are Lundin Gold and Dundee Precious Metals. Their margin's about $1,700 per ounce, which is about, let's say, 60-70% margin. Seems to be some very healthy companies out there doing some very, very good things. Is that enough to attract investors back to the sector?
I think so. Look, I think the problem of attracting investors back to the sector is a structural one, because it is a very, very small sector. Right? 450 billion for the top 50 or whatever it is companies in the GDX, makes this one of the smallest global sectors out there. There are very few gold miners in anybody's benchmark, and that means that it's a very easy sector for benchmarked investors to completely ignore. And if they invest in the gold mining sector, often they're stepping out of their benchmark, so they're taking kind of a career risk or whatever, which they don't get rewarded for, and they get punished if it goes wrong. And let's face it, stuff does go wrong in the gold mining industry on a fairly regular basis. So I kind of understand that, big generalist investors just shun the sector. And, now if you look at the free cash flow yield of the sector, it's improving with this huge rise in the gold price. Maybe it's 6 or 7% now, which for the industry as a whole, which is starting to look quite attractive. Will that be enough to bring people in? I'm not so sure.
Okay.
I'm not so sure.
So if there's one of the big issues is structure and scale, then that's obviously a very incredibly difficult thing, perhaps even an impossible thing to address.
Yeah. I think we've just got to realise that this is a kind of small specialist sector. It's one where you can generate a lot of alpha through stock picking. It's one where you can actually make money for yourself. But is it going to be the sector that everybody's talking about in the same way as they've been talking about tech for 10 years? Is that going to happen? I kind of doubt it. Right?
I probably agree with you there. Now, you mentioned, David, that you recently started a new copper fund, so let's talk about the red metal a little bit.
Yeah.
The copper price has been, I think it's fair to say, relatively flat over the past couple of years, until the start of this year when it started really driving up copper futures. I think went up to about $4.80 per pound. It pulled back a little bit to, let's say, $4.50 a pound. Why is copper starting to surge?
Well, I do think that that's also a little bit technical, right? So the COMEX futures now trade at a fairly significant premium to the LME price for spot price for copper. And I think that there has been some significant stocking of copper, particularly in the US, because people are concerned that tariffs might be applied to imports of copper. And the US in particular, it's not a huge user of copper on the global scale. I think it's 6 or 7% of the global market. But if US users fear that there may be a 20% tariff applied to imported copper, and the US imports most of its copper, then you can understand that they would try and secure supplies ahead of that kind of event.
When we look at the sort of broader copper landscape, there's a structural supply deficit forecast to come in the coming years, and by the end of the decade. There's been talk of mega mergers between some of the diversified or bigger copper companies. Several have been touted, but none have really sort of come to fruition. The cost of building projects seems to be going up exponentially, even for brownfield expansions. So presumably that makes the mining CEOs and their boards adverse to making these decisions. What's your view on the lie of the land in the copper space at the moment?
Yeah. Look, I think, the energy intensity of GDP is rising. That means the world needs to generate more power, and it needs to be able to transmit and distribute that power. And copper is, obviously, it's marginally substitutable by aluminium, but in many applications it's not. And that should mean that the demand growth outlook for copper increases over the coming years. And as you rightly point out, the industry is poorly set up to supply any kind of out of consensus rise in the demand for copper, because copper projects take so long to build, and the incentive price for those builds, I think, should be much higher than the current copper price. And even if you look at existing mines, or miners with existing assets, at today's costs, they're not generating much free cash flow with copper at $4.50 and cash costs at $2. But that looks as if they should be making good operating margins, but when it comes to actually what's left after the sustaining and whatever growth and reserve replacement they're doing, they're not generating much cash. And with those marginal kind of cash returns from existing projects, that doesn't incentivize you to take a big risk and gear up your balance sheet and build large new projects.
And of course, even relatively modest copper projects today are multi-billion-dollar projects that take several years to build, so you have more risk for an extended period of time. Copper is one of the metals that's been involved in the energy transition narrative. Obviously, it's the industrial metal. It's used for passing power from A to B. And as part of the energy transition narrative, there's been talk in various different countries about whether or not new copper production should be subsidised, whether generation or transmission should be subsidised or not. Is that creating, let's say, uncertainty, which again handicaps the copper companies from making their investments because they don't know whether there's going to be subsidies available or not, or what's going to be built or not? Yeah. And so it's perhaps led to, a certain sort of paralysis in a way.
Yes, I think that, if there's going to be a shortage of copper, you shouldn't need to subsidize people to build copper mines, right? The natural economic incentive should be there. And I'm always very wary of investing in projects which need subsidies in order to function. So I'm not sure that people are hanging around waiting for handouts in order to build new copper mines. I think it's just, the profitability versus the risks of doing so is just not wildly attractive today.
So let me ask you, you said you started a new copper fund. Why did you start a new copper fund? What are you investing in with that fund? Yeah,
so look, we've talked about a deficit in the copper market for a long time. Every year there's going to be a deficit next year or in 2 years' time, and sometimes there's a small deficit, but more often there's a small surplus. So that hasn't quite played out. I think the energy transition is a very significant factor that will end up having an impact on the copper price. And I think that people misunderstand the energy transition. People think it's about carbon emissions or saving the planet, and I don't believe in that for a second, actually. I think the energy transition is all about energy self-sufficiency, which is why China's doing it, right? They're not doing that to save the planet. They're doing it because they're highly dependent on the outside world for their energy, and that's not a comfortable geostrategic position for them. So they're going hell for leather to generate as much electricity as possible on the national soil, whether that's through solar or wind or nuclear or whatever. They don't care. I think that that is having a huge impact on the demand for copper. I think copper's being substituted elsewhere, and so that's not really being seen in the price formation yet. But the Chinese national grid last year probably bought 3 times as much copper as the whole of the Chinese construction industry, right? Where demand is falling, right? So that's a partial offset. But I think the nature of copper demand is changing, and at some stage, and I think you have to be patient with commodities because commodities never discount future deficits until they actually happen. But I think it will happen. And, I think by the end of this decade, we will have much, much higher copper prices. Investors in decently managed copper companies will make supernormal returns over that period. But, that's 5 years. It could happen at any time during those 5 years. It may not be this year,
Well, that's one of the key success factors to investment, isn't it? Positioning and then the patience to let that thesis run its course.
Exactly. And so that's why we set it up. We do see that happening, but, people say, well, I get this question from clients. They say, well, if there's going to be this huge deficit, why isn't the copper price already much higher? And that's not how commodity markets work, right? Price formation is influenced by immediate supply and demand, not by what might happen in 3 or 4 years' time.
Excellent. Well, David, that's been fascinating conversing with you. David, thank you very much for joining us today.
For your questions. Thank you.
We have more to come from the 2025 Mines and Money Conference here in Miami, in Florida. So hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of Mines and Money in Miami, Florida is brought to you by Gold Shore.